please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Business Lunch. I'm Nisha Podar and with me is Sonia Shenoy. Sonia, good afternoon. On Monday afternoon, well, the markets are sluggish at lunch hour at this point. Nifty 50 just about struggling to maintain the 10,800 level. The biggest dip and the cut coming in the mid-cap universe once again, and therefore the market breadth is also looking weak. But surprise, surprise, ICICI Bank is the biggest contributor in terms of gains, while most of the other blue chip banking counters are dragging. Oil marketing companies as well as autos really saved the day for the market, Sonia.
Absolutely. I think the mid-cap fall, it's very similar to what we saw on Friday, right? The kind of fall in the mid-cap space. The market breadth is quite weak today. More than 1,400 stocks on the declining side. It just tells you that the mood of this market is not good at all. At least it's not in favor of the bulls. In terms of losers, it's the metal space that's coming in for a lot of pressure today. Vedanta, Hindalco, GSPL are all down and out. All right, but the Asian markets have also closed low, at least the ones that are open. Trade tensions between the US and China with new tariffs on the table. More than 800 Chinese goods, remember, are due to get an extra 25% tariff starting on the 6th of July. China too has responded with a 25% tariff that will be applied to certain US products starting on the same day. European markets open lower as China-US trade tensions intensify.
All right, so that's about the global markets, but one particular bit from the commodity space which is really catching our attention and is going to be a big factor for the Indian markets too is going to be the oil prices. Crude oil ahead of the OPEC meet this week, and those prices have seen a fall. Let's take it straight to Manisha Gupta, who will give us the insights on what to expect and what are the factors right now at play, Manisha.
Thank you so much for that, Nisha. Well, yes, you have seen the crude oil prices trade at multi-month lows for both of those varieties, and prices are off nearly 10% from the May highs there. And if there is an increase or there is a decision to increase supplies from the OPEC meeting in Vienna on 22nd of June, you will see further pressure come in case of the crude oil prices. As of now, we already have seen a bit of a discord between the OPEC members, where you have Saudi Arabia and Russia actually talking positive on increasing supplies, but Iran, Iraq, Venezuela are talking against it. So it's going to be quite important, quite interesting as we get into Thursday and Friday into that meeting. But until that, this space is definitely going to be jittery, and you could see yet another slide come in the next couple of days.
Okay, Manisha, also about metals, I was just talking about how the listed stocks, have fallen quite a bit today. Globally too, copper, aluminum have all cooled off?
Well, absolutely. You could blame the underlying commodity for that, because we are looking at copper prices trading at a 2-week lows. You have aluminum and zinc trading at a 2-month lows as well. And this is after 2 to 4% of decline that you saw in the metal space in the previous week as well. So the Chinese data has not been positive. You also are looking at the US and China retaliation with the trade war thing going. That also is adding to uncertainty, and the demand really seems to have slowed down in last couple of weeks. You have seen an increase in warehousing inventories for many of these metals, and then add to that the strength in US dollar. It's a complete recipe for further decline here.
All right, further decline expected in the metal prices, and oil is also looking weakish today. Let's get back to talking about the equity markets now. And Anuj Singhal, our colleague, caught up with a veteran of many market cycles, Shankar Sharma, and he says that barring a few bad apples, the card still looks pretty good.
Are we still in bull market? Because while the Nifty might be at 10,800,
it doesn't feel like
it. Doesn't feel like that. A lot of my friends say
it's like the weather forecast. The weather report you see.
Exactly.
The temperature 31, but feels like 35.
Exactly. A lot of people say my portfolio looks like 10,200. Some say my portfolio looks like 9,800. And the ones who have been invested in the 1% of the world say that my portfolio looks like the Nifty is at 6,500.
Well, I mean, that's the market for you. It's a mirror with a lot of individual facets. So depending on which facet is suiting you, you can choose that facet. I think for people who were unlucky, and I can only say that, if you're stuck in a stock like Manpasand or even Vakrangi or whatever, I can only put it down to bad luck, because, if, dodgy accounting is a problem. I think there are many, many companies, including very large ones, who have the same or similar things. And that's true globally. But, it's your bad luck if, it was suddenly whistled out and, somebody blew the whistle on it. But on the other hand, I mean, I think just small caps, which are sort of problematic, like these names, I think they have held up very well. And in fact, from the peaks of January, they are down about 25% or so,
Yes.
more or less. Which, in any good correction, you would expect a small cap to fall at least 25, if not between 30 and 40%. That is par for the course. I don't think there's anything untoward at all.
Okay.
And you know, I think I don't know whether it's been with you or maybe some of your colleagues, that in 2008, you know, that's a very good year to analyze data, okay, about market falls, because that is the biggest fall that a whole generation of investors has seen, and I doubt if we'll see another one like that when 60% index fell.
Yes.
Just an index fall of 60-65%, which
Yes.
tells you stocks fell like 90, 95, 99%, right? If you look at that data, the ones that were below the market in terms of fall, which is below, I mean, rather more than 65, okay, which are real estate, commodities, and some banks, you know, infra, all of them had only one thing in common, and which was leverage. All of them had debt. Companies without debt actually fell far less in the market. So the worst in those lots, I mean, M&M, etc., were like down 50%.
Yes.
Now imagine in a year like 2008, which is never going to happen to the best of my understanding, the worst that the unleveraged stocks fell was 50%. That means in a normal correction, if you're down 25, 30, this is not a 2008 by any standards.
Yes.
Nowhere in the world. 25, 30, 40, you're done. This is it. It doesn't get any worse than this.
And you can catch the whole conversation with Shankar Sharma tonight at 8:30 p.m. only on CNBC TV18.
All right, let's take a short break on that note. But up next is our special series, Hunting for Value. And today we'll focus on a pharma stock which has lost 25% from its 52-week high, is seeing competition in two key drugs. Is there value here? More details on the other side. Hi, welcome back. You're still watching Business Lunch on CNBC TV18. Now, it has been over a year since the mega merger between Idea and Vodafone got announced. The decks are all set to be cleared to create the largest telecom company in India. In fact, Idea is in focus this afternoon as well. The last time I checked, it was up in the green. Nisha, finally, this is coming through, the clearance.
Oh, yes, Sonia. In fact, I was just looking at the timelines. In August 2016, we had broken the story and they had actually announced it a little over a year back. And now we are going to probably see the light of the day when it comes to the merged entity of Idea and Vodafone. In fact, sources do suggest that the Department of Telecommunications is likely to give the final nod this week itself. And it's just a matter of days, with 2,100 crore rupees of spectrum dues to be cleared by Idea, and then also giving a guarantee for future dues as well. It is much lower than the 19,000 crore rupees which was being earlier talked about, but the Bharti Telenor deal actually gave way, and that particular court matter really gave way to an easier clearance for this particular merger to go ahead. What we are going to see is the largest telecom company in the country, what, $23 billion, having a market share of over 35% in the country and 430 million subscribers. But also look at the landscape currently. It is challenging at this point, and the key challenges for the company clearly is going to be the huge debt pile that the combined entity will really start with, over 1 lakh crore rupees. So that needs to be watched out very, very carefully. Also at a time when the revenues are declining and the pricing pressure is high. But remember, synergies are there between the two combined entity coming together and making a solid fit. So that can really probably counter the competition much better, hopefully. And they've already started kicking in some of the synergies, especially in terms of monetizing the tower assets of the company.
Okay, all right, Tanisha, thanks a lot for summarizing that for us. That deal will definitely be in focus, but time now to hunt for value. Today, we are highlighting a pharma stock that bucked the trend in 2017, but seems to be losing a bit of flavor now. Or is it? Ekta has more. Ekta, over to you.
Well, the stock that we are talking about is Cadila Health. It saw a 40% rally in the span of a few months in 2017, bucking the trend in the pharma sector, but really fizzled out since then and is now about 25% off its 52-week high. From then, it saw that re-rating because of that warning letter being lifted from its Moraiya plant in 2017. And despite strong launches in the US and a good regulatory track record, it failed to sustain that momentum that we saw in 2017. Now, the reason for the underperformance is quite a few. It's likely, however, to be mainly due to a lack of significant triggers for the company. This is because a few of their biggest launches, like I mentioned, Lialda and Tamiflu generic, were already done in FY18. Hence, for FY18, despite the company guiding for growth, it will come at a high base for FY19, making the street a little skeptical on whether they'd be able to achieve that. More so, these same drugs, which is basically the ulcerative colitis drug Lialda generic, as well as the flu drug Tamiflu, will see more competition this year, hence reducing the contribution in terms of the total numbers. Now, the other risks obviously include delayed approvals in the US, as well as, just a lack of execution by the company. They'll receive approvals for the drug, but they won't be able to launch it. Plus, US price pressure and overhang of a possible fundraising cards as well. However, the triggers, according to analysts, could be the following. If the company launches 50 drugs as estimated by the street in the US, including key drugs such as blood pressure drug Toprol and digestive drug Prevacid. Also, the company expects its biosimilar and vaccine business to scale up in the next 3 to 5 years, but it is taking steps. So any sort of constructive step towards building it would be a positive for them. A continued clean track record of FDA inspections would also be important. For example, the company cleared 7 out of 9 observations by the US in FY18 without any observations. So that is an important trigger in terms of them continuing that sort of track record. Also, something which will be important will be the Moraiya plant in specific. Now, in terms of brokerages, Deutsche Bank has a buy rating with a target price of 447 rupees. JP Morgan is neutral on the stock with a target of 400 rupees. Now, in terms of the peer comparisons, it seems as though Cadila right now is a little lower than its frontline peers on an FY19 and FY20 basis when you talk about price to earnings. So let's see whether that catch-up eventually takes place. But before I wrap up, a quick disclaimer as well. The stock is not a buy recommendation by us.
All right, so that was Ekta on Cadila, but let's shift focus to ICICI Group and ICICI Bank. That's roaring in trade today with probably uncertainty coming down as far as the top leadership is concerned, but ICICI Pru Life is a stock to watch out for. That is down in trade today, is showing fair amount of weakness. Now remember that big news of the day, ICICI Prudential Life Insurance, Sandeep Bakshi may be appointed as ICICI Bank's new interim CEO. In fact, a board meet to that effect could be slotted today. Ritu Singh joins us on the phone line to give us all those important details. Ritu, good to have you on Business Lunch. So looks like Chanda Kochar's leave is going to be extended more than earlier anticipated.
Absolutely. Actually, as we speak, the board meeting for ICICI Bank is currently underway. The two important issues which we've been able to gather so far that will be taken up during the meeting that is being held currently is one, of course, further ratification of Justice Sri Krishna as the head of the independent probe committee, the appointment of law and advisory and audit firms that will, help him in this probe. And second and more importantly will be the fate of Chanda Kochar, whether or not she will proceed on an indefinite leave. And, if the board does decide that Chanda Kochar will not be joining the bank while the independent probe is on, then if an interim CEO will be appointed. And as news report across newspapers suggest, Sandeep Bakshi is indeed, the most favorable candidate among the lot that the board may consider. Of course, we've been able to gather from our sources that no final nod has been given by the board on who the interim CEO will be. That is something that should come up in today's meeting. But given that Bakshi is the senior most among the ICICI Group company executive, it is likely he will be appointed. Do remember, Chanda Kochar's term is coming to an end on March 31st, 2019. But she proceeded on leave, which the bank called her annual leave, towards the end of May and was supposed to join this week, as per our sources. But no word yet on whether or not, Kochar will be joining in. But an an announcement to this effect is likely from the bank either today or sometime early this week.
Okay, so the CEO's fate will be decided in just a few days from now, or maybe even today. Ritu, thanks so much for giving us an update on that. That's clearly a story of high interest. The stock is up 2.5%. We'll take a break and come back with lots more on the market. And TCS is the stock on our radar. The board has approved the 16,000 crore rupee buyback. More on that when we return.
Welcome back. Now, remember, for the IT companies, buyback season to utilize their cash pile has been really the flavor of the season. Last year, it was Infosys and Wipro. Now, TCS is back. Last week, they announced the board has approved 16,000 crore rupees of buyback. But what does this really mean for the retail investors? Nigel D'Souza is here with a detailed analysis. Nigel.
Well, let's run you through first the basic details. It's a 16,000 crore buyback, and the price they're looking at is around 2,100 rupees on a per share basis. But retail audience wants to know, what's our eligibility? Well, you need to hold shares up to the value of around 2 lakh rupees approximately, and 15% of the total buyback amount is reserved for you. That's if you qualify in that sub 2 lakh worth of shares. So going by the current number, 16,000 crores, 15% of that, around 2,400 crores are reserved for the small shareholders. Now, the current market price is at around 1,840 odd. So for you to qualify, and if you're looking to buy now, you'll have to buy around 108 shares approximately to come in that quota of around 2 lakh of holding shares worth the value of around 2 lakh odd. Now, let's take the scenario. You're buying currently at around 1,840. The buyback price is around 2,100 rupees on a per share basis. 3 scenarios now should come up for you on the screen. One is in terms of the acceptance ratio. 50% of that gets bought back at around 2,100. Then, in fact, your break-even price comes down to around 1,580. Assuming 90% gets bought back in the buyback, then your break-even point will come down all the way to around 500 rupees on a per share basis. Remember, last time around, all the shares you tendered in got picked up in the buyback. That was 100% got tender. So just keep that in mind as well. But everyone's talking about what are the profits we are going to be making. Let's tell you what are the costs you'll be incurring. One is your transaction cost for buying these particular shares and then tendering it in the buyback. Well, your transaction cost will be around 1,000 to around 1,400 rupees approximately. Second factor is you need to calculate the opportunity lost or even the borrowing cost. You know, if you're borrowing at around 8%, then your effective cost for around 3 months will be around 4,000 rupees. If you're borrowing at around 12%, your effective cost is around 6,000 rupees. This is only for a span of around 3 months. And finally, short-term capital gains as well is what you'll have to pay. So assuming you're making a big profit of around 27,000, 4,050 rupees. If you're making around 16,000, 2,400 rupees. Stack these numbers up. One, you're paying the transaction costs. Second, you'll have to keep some time value of money. And finally, short-term capital gains. So in all, the definite cost you'll be incurring is around 8,000 rupees approximately. Finally, a lot of retail out there, they would have got shares in the bonus, right? What's the cost of acquisition? It will be counted as 0. If these shares get bought back at around 2,100 rupees, you'll be paying tax of around 315 rupees because the shares that you got in the bonus, effectively the cost of acquisition will be absolutely zilch. So that's a guideline for all our retail audience out there. Keep this in mind when you're looking to play that entire TCS buyback.
All right, so FIFA fever is clearly on, Sonia, but what the hell, let me be a killjoy because it's Monday and we still have work to do. So Business Lunch is over. Midcap Radar comes up next for all the market action. Stay tuned for that.